Ms. Hazel Poor.
Mr. Speaker, sir, may I have your permission to take questions 23, 24, and 25 in today's order paper together, please?
Please proceed.
Mr. Speaker, my response will cover the questions raised by Ms. Hazel Poor, Associate Professor James Lim, and Mr. Don Wee in today's order paper, as well as Mr. Yip Hon Wing's question filed for tomorrow's sitting. If Mr. Yip is satisfied with the response, he may wish to withdraw his question after this session. Associate Professor James Lim asked about the components of the net loss, including from MAS's currency intervention. MAS had explained in detail the constituents of its reported financial loss at its annual press conference in July, which I will reiterate here. About 70% of the net loss was due to the negative currency translation effects of a stronger Singapore dollar. This is not due to currency intervention. The negative currency translation effects arise because the official foreign reserves, or OFR, are held in foreign currencies but reported in Singapore dollars. Therefore, a stronger Singapore dollar will result in a lower value for the OFR when expressed in Singapore dollar terms. This currency translation effect does not have any bearing on the external purchasing power of the OFR or on MAS's ability to conduct monetary policy. Now, the remaining 30% of the net loss was due to net interest expenses from MAS's money market operations to mop up excess liquidity in the banking system. The net interest expense incurred on MAS's money market operations to mop up this excess liquidity in the banking system was unusually large in the last financial year due to two factors. First, the large volume of operations and higher interest rates. The large volume of operations and high interest rates. Now, the high volume of money market operations was necessitated by MAS's interventions in the foreign exchange market to moderate the appreciation of the Singapore dollar. As MAS explained earlier, had it not done this, the Singapore dollar would have been too strong and therefore hurt the economy. While this currency intervention added substantially to our OFR, it created excess Singapore dollar liquidity in our domestic banking system, which MAS had to remove and therefore incur an interest expense in the process. Now, Mr. Don Wee asked if MAS plans to increase the interest yields and payments of treasury bills and bonds to curb losses and encourage a higher level of savings. Now, such instruments are issued by the government and not by the MAS. The interest rates payable on such instruments are not determined by MAS, but are market determined via auctions. As the interest rates of such instruments have increased in tandem with the rise in global interest rates, we have already seen a healthy pickup in demand by the public. Mr. Yip Hon Wing asked whether there are plans to broaden the basket of currencies in which the OFR are held. The OFR is already held in a diverse range of currencies. As long as the Singapore dollar appreciates against these currencies, there will be negative currency translation effects. In the last financial year, the Singapore dollar appreciated against every major currency. As MAS explained earlier, the effects of a stronger Singapore dollar, cannot be hedged or diversified away. Let me now respond to members' broader questions on monetary policy. Ms. Hazel Poor asked about the benefits of a stronger Singapore dollar in view of the financial losses recorded by MAS. The appreciation of the Singapore dollar last year reflected the outcome of MAS's tighter monetary policy to dampen inflation. This policy has been successful in curbing imported inflationary pressures. Let me explain how. Between May 2022 and June 2023, Singapore's import price index had fallen by some 14%. This decline in import prices has in turn contributed to lower domestic inflation. On a month-on-month, seasonally adjusted annualized basis, MAS's core inflation fell from its peak of 9.1% in June 2022 to 2.2% in June 2023. Mr. Yip asked how MAS strikes a balance between managing inflation and incurring losses, and whether these losses are anticipated. MAS's monetary policy is focused purely on keeping inflation low and ensuring medium-term price stability. It does not take into account any potential impact on MAS's profits, because to do so would undermine its mission. This is similar to how other major central banks conduct monetary policy. Many of them have also reported losses arising from their monetary policy operations. MAS's financial performance is a necessary consequence of its conduct of monetary policy. The OFR is key in enabling MAS to conduct effective monetary policy. As a central bank, the MAS adopts a conservative approach in its investments, with a significant proportion of its portfolio invested in liquid financial market instruments. Through a well-diversified portfolio and current and careful risk management, MAS expects to earn good long-term returns that are commensurate with its risk profile. Finally, let me turn to Mr. Yip's question about the impact of MAS's net loss on the government's budget position. Now, MAS contributes to the government's budget in two ways. First, under the Net Investment Returns or NIR framework, the government can spend up to 50% of the expected long-term real return on the assets invested by MAS, GIC, and Temasek. The NIR is based on the long-term expected returns of these entities and hence is not affected by their short-term performance. Accordingly, MAS's reported net loss in the last financial year has no impact on the NIR that is available to the government. Second, similar to other statutory boards, MAS makes contributions to the government's consolidated fund in lieu of corporate income tax. Now, this is based on 17% of the net profit for the year after offsetting cumulative losses from previous financial years. The government recognizes that MAS contributions will vary considerably from year to year and has therefore smoothened the revenue volatility by requiring the annual contributions made by MAS to be paid in equal proportions over a period of 3 years. Now, given the net loss in financial year 22-23, MAS will not accrue a contribution to the government's consolidated fund for that financial year. Nonetheless, MAS will still make a contribution of 0.4 billion Singapore dollars to the government's consolidated fund in the current financial year based on past profits. Now, this smoothening formula has thus helped to mitigate the impact of MAS's net loss on the government's budget. In sum, MAS's overarching mandate is to ensure macroeconomic stability. As DPM Lawrence Wong stated in this House on 1st of August 2022, the government does not expect MAS to deviate from its mandate to maximize its contributions to the budget. MAS's monetary policy has helped to deliver broad macroeconomic stability for over 40 years as the basis for sustained economic growth and increases in real incomes for Singaporeans.
Ms. Hazel Poor.
I thank the MOS for its answer. I'd like to seek, I have a SQ, which is that the MOS has said that the benefit of the strong dollar policy is to dampen inflation. Now, given that domestic consumption is 192 billion, and this recorded loss of 30.8 billion is a big sum of money, equivalent to about 16% of domestic consumption. How much has it dampened inflation, and compared to the 30.8 billion, what is the official cost-benefit analysis and the assessment on the efficacy of this policy?
So I thank the member for SQ. As I mentioned earlier in my reply, the loss is attributed 70% to net currency translation losses and 30% to interventions in money market operations. These are the normal functionings of how central banks conduct monetary policy, and with its goal to dampen inflation and to have medium-term price stability. So that, to put that into context. Now, on its impact on price stability and its impact on inflation, I had mentioned that in my PQ reply, but let me also explain that if MAS had not tightened monetary policy, quarterly core inflation would have reached 7.2% year-on-year at its peak, 1.9 percentage points higher than the actual peak of 5.4% year-on-year in the first quarter of 2023. So inflation would have stayed higher for much longer and brought about much more significant increases in the cost of living for households. Therefore, MAS's conduct of monetary policy has made an impact. We are still seeing that impact over the course of different quarters, having tightened monetary policy 5 times since October 2021.
Associate Professor James Lim.
Thank you, Speaker. One motivation behind my request for a breakdown in the numbers was because MAS had previously explained that it would look to strategically strengthen the Sing dollar against, for the purposes of addressing imported inflation. This was a move that I supported, and in fact, MOS Tan has reiterated this MAS position that the Sing dollar has indeed appreciated against every major currency. That said, based on my understanding of the data, between January and July 2023, the movements of the Sing dollar were essentially the converse of the US dollar. So in particular, when there's a strengthening of the US dollar, the Sing dollar would weaken, and when the US dollar weakened, the Sing dollar would strengthen. In particular, for the US dollar's 2 most recent peaks at the beginning of June and July, this broadly corresponded to troughs in the Sing dollar US dollar rates. This actually suggests to me that MAS was not really leaning that much against the wind, or if it did, it wasn't doing so with sufficient interventions that would have altered the overall US dollar trends. And therefore, attributing losses, the 30% that MOS Tan mentioned, to sufficient interventions does not strike me as credible. So my follow-up question then is whether the MES actually views this earlier strong dollar policy as successful, and if so, why in March it announced a decision to ease the Sing dollar policy?
So I thank the Associate Professor for his SQ. I think it's really important to note that the Sing dollar, there's a trade-weighted basket of currencies, not just the US dollar. Therefore, you need to look at it as a whole basket of currencies. And we look at it from a very much a long term. First, on currency translation effects, I've explained that technically. The second is on currency intervention and as well as money market operations. Because of the Sing dollar was already on an appreciating trend. And in addition to high savings rates, as well as capital inflows, a large volume of capital inflows, the MAS also intervened by selling Singapore dollars and therefore moderating the appreciation rate. Had it not done so, then you would have a lot of, you would add to inflation. But when you sell Singapore dollars into the domestic banking system, you will then have to undertake money market operations. This is the normal conduct of central banking policy. What the MAS then does is to sell, repos or T-bills, of which it then has to pay interest payments on. And these interests, in line with global interest rates, have risen, and therefore, when we issue a T-bill, for example, we'd have to pay a higher interest rate. And that adds to that 30% account of the loss that we are talking about today. So just explaining the technicalities of how this works, trade-weighted, as well as why we need to conduct money market operations to moderate the appreciation of Sing dollar. Thank you.
Mr. Donby.
Thank you, Speaker. Can I confirm with MOS Tan that the loss is a result of currency translation as well as MMO, so as to help Singaporeans, especially the SMEs, to cope with the rising business costs as well as the rising cost of living? Thank you.
Thank Mr. Donwy for his question. In fact, that is the whole purpose of MAS's monetary policy. It is to manage price stability as well as to manage inflation. And we have done so. I explained in my PQs and the SQ to Ms. Hazel Phua. Let me just reiterate a few points that how the policy has been successful in curbing imported inflationary pressures. Again, I said that between May 2022 and June 2023, our import price index had fallen by some 14%. So in concert, this has dampened. Had we not done so, I think the cost of living would be higher, imported inflation would be also higher. Thank you.
Mr. Yip Hong Win.
Thank you, Mr. Speaker. I thank the MOS for its response. I have one SQ. I wish to ask how has MAS investments been thus far and its impact on our official foreign reserves. Thank you.
Sir, just to take a step back and just to also state to the House that the relevant measure of MAS's financial performance is not currency translation effects or interest expense, but how well its investments have done. MAS made a small gain of $0.6 billion on its investment portfolio amidst a depressed market environment. And last year, as members would know, was an unusual year for financial markets, where bond markets, equity markets performed very badly. But in this case, MAS's investment performance had to be viewed from a longer-term perspective. Since the 2008 global financial crisis, MAS's investment portfolio had benefited from an unusual period of low inflation as well as low interest rates. Including this latest year, MAS recorded an annual average investment gain of 11.7 billion Singapore dollars in the last 15 years. Now, MAS seeks to preserve the external purchasing power of the OFR over the long term to support monetary policy implementation. So over a 20-year period, MAS's average annual investment gain was 3.7%. Notwithstanding the financial loss that we had been discussing, MAS's OFR position remains strong, and we transferred 191 billion Singapore dollars of excess OFR to the government. Thank you.
Associate Professor James Lim.
If I may just quickly clarify my earlier supplementary question, I appreciate what MOS Tan shared about how the Sing dollar is measured against a basket of currencies. But in particular, could I confirm with him that MAS did indeed reverse its strong dollar policy in March of this year? And if so, what were the factors that led to its decision to subsequently make that reversal after making a case for strengthening the Sing dollar?
As I mentioned to the member earlier on, it's measured against a trade-weighted basket of currencies. We have tightened monetary policy 5 times since 2021, and there was no such announcement.